Picture this. You wake up Monday morning, February 16th, 2026. Your coffee is bitter and your portfolio is bleeding red. 30% of your paper wealth gone in one weekend. And while everyone calls it a correction, what actually happened to silver is a forensic crime scene, not a normal market move. I'm OG John AG, and in this video, I'm going to show you why Friday's little green candle was a trap, how Western algorithms use China's Lunar New Year shutdown as a liquidity ambush, why this 30% crash is really leverage exploding, not silver losing value, how the physical market just decoupled from COMEX paper like oil did in 2020, and what separates the weak-hand tourist from the insider who turns this into a clearance sale instead of a catastrophe. Segment 1, the Friday fakeout and the weekend ambush. Let's rewind to last Friday. Silver finally printed a green candle after a brutal week. Price ticked up, forums cheered, thumbnails screamed, bottom is in, and you went into the Lunar New Year weekend thinking the worst was over. That tiny bounce wasn't a bottom. It was a liquidity vacuum. High-frequency trading bots and market-making algorithms did what they always do in thin conditions. They pulled the price up on low volume to see who would bite. They painted the tape just enough to tempt you into opening fresh longs, adding leverage, borrowing money to buy contracts for metal you'd never touch. They were fattening the pig before the slaughter. Then came Sunday night in New York, Monday morning in Asia, except there was no Monday morning in Asia. The Shanghai Gold Exchange closed. The Shanghai Futures Exchange closed. The biggest physical buyers of silver on the planet, at home, eating dumplings, handing out red envelopes, celebrating Lunar New Year. The dragon was asleep, and Western algorithms knew it. With Shanghai dark, the order book was a liquidity trap. No deep Chinese bid to catch falling prices. Very few real buyers on the other side. So the banks did what they always do in an empty house. They pulled the rug, triggered a coordinated sell program into a vacuum. Price didn't just drift lower, it teleported, smashing through support like a bowling ball through wet paper. That's what silver's 30% weekend wipeout was, not value disappearing, but liquidity being weaponized. Segment 2, Waterfall declines. How leverage dies in public. David Morgan calls this a waterfall decline, violent, fast, and mostly artificial. Mechanically, here's what happened. One big leverage trader hits a margin call. Their position is auto-liquidated. That forced selling pushes price down. Lower price triggers the next level of stop losses, which forces more liquidations. Each margin call begets another until it becomes a domino chain of digital bankruptcy. The number on your screen, whether that's $80, $75, or whatever it shows this second, is not silver's true value. It is the price of leverage exploding. That's the critical concept of this entire episode. You are not watching silver being repriced. You are watching other people's bad bets being repriced to zero in real time. The market does not hate you. The market does not know you exist. To an algorithm, you're just liquidity, a data point in a spreadsheet that can be deleted without a second thought. Segment 3. Two silver prices. Paper hallucination versus physical reality. There are now two different prices for silver, and if you don't understand the difference, this week will wreck you. The paper price, COMEX futures, ETF shares, contracts that claim to represent silver, but mostly never result in delivery. The physical price, coins, bars, 1,000 Oz bricks, and vaults. The stuff you can hold in your hand, drop on your foot, and ship to a factory. Right now, the screen is screaming about the first price. If you want to know the second, do this. Pick up the phone, call a major bullion dealer, ask, will you sell me an ounce of silver at today's COMEX spot? You'll get one of three responses. A laugh. We're out of stock. Or a quote with a premium so high it makes your eyes water. Why? Because the physical market never agreed with this crash. While paper silver is being puked out at fire sale prices, the actual metal is disappearing into strong hands. Dealers see the same tape you see, but they interpret it differently. They know this is a liquidity event, not a demand collapse. They know mine supply didn't magically surge. They know industrial demand didn't vanish over a weekend. So they are raising premiums, restricting supply, hoarding inventory instead of dumping it. The more the paper price falls, the more aggressively the physical price decouples. Segment 4, negative oil, 2220. We've seen this movie before. If this feels insane, it's because we've seen the same movie with a different commodity. Go back to April 2020. The world was in lockdown, highways empty, airlines grounded. On one infamous day, West Texas Intermediate crude oil on the futures market didn't just fall, it went negative $37 per barrel. The screen told you, oil wasn't just worthless. You had to pay someone $37 to take it away. Ask yourself, did gas stations pay you to fill up? Did the cashier hand you $50 to drive away with a full tank? Of course not. Pump prices stayed around $2, $3 per gallon. What happened? Futures traders were trapped with contracts they couldn't store. Algorithms panicked. They sold into a void, and the digital price crashed into negative territory, a number that makes no physical sense. The physical commodity didn't lose value. The paper trading structure around it broke. This silver crash is negative oil, the sequel. The Western paper system is hyperventilating. Leverage traders are getting obliterated. Algorithms are following code like if price X, sell Y, creating a feedback loop of stupidity. Meanwhile, the real world, mints, refineries, solar factories, is looking at this and quietly saying, discounts? Thank you. We'll take all the metal you've got. Segment 5, East versus West, checkers with paper, go with atoms. While London and New York are panic selling paper contracts, the East is playing a completely different game. Right now, Shanghai's lights are off. Vault doors are closed for the holiday. Traders in China, India, Vietnam, cultures that have treated gold and silver as money for thousands of years, are not glued to Western charts. They see this for what it is, a temporary Western fire sale. The West plays checkers with derivatives, margin, ETFs, numbers in bank accounts they treat as wealth. The East plays go with ports, mines, refineries, bars, and coins. When the Shanghai Gold Exchange reopens after Lunar New Year and traders see silver 30% cheaper than 2 weeks ago, do you honestly believe they'll sell? Or will they smile, back up the truck, drain more physical metal out of London and COMEX at a discount? This is planet-scale arbitrage. The West is dumping paper into a liquidity trap. The East is waiting patiently to scoop up atoms cheap. You're watching a wealth transfer from impatient leveraged paper speculators in New York and London to patient physical accumulators in Asia. Segment 6, Ghost Market Economics, when spot drops and premiums spike. Here's the part that should not happen in a healthy market, but is happening right now. Spot paper price crashing, physical coin and bar prices rising. The spread between paper fantasy and physical reality has blown out to historic levels, wide enough to drive a truck through. The screen says, silver is trash. The physical market says, silver is vibranium, essential, scarce, and vanishing from vaults. Call a refinery, a wholesaler, a bullion dealer. Ask for a 1,000 Oz bar today at COMEX spot. You'll hear, sold out, maybe in 3 months at this price, if we have it. Or, if you want metal now, you pay way above spot. That's the ghost market. The screen price falls, the real world price rises. Every dollar lower on COMEX pulls more metal out of the system. Industrial buyers, Samsung, Apple, EV makers, defense contractors, don't see an ugly chart. They see urgency. They panic buy, not panic sell, because the only thing worse than paying up for silver is having no silver and a dead production line. So that red line on your chart is not just value going down. It's the inventory of the system being drained. The lower the paper price goes, the faster the vault's empty. You are watching a bank run, but the bank holds metal, not cash. And unlike cash, central banks cannot print silver. Segment 7, Traders versus Owners. Who just paid tuition? This crash is not just about money, it's a psychological filter. If you bought silver because you saw a green line going up last month, loaded 5 to 10x leverage, thought you could outsmart a supercomputer, then this morning you opened your account, felt that cold pit in your stomach, smashed the sell button, locked in huge losses. You just paid very expensive tuition. The lesson, leverage is a double-edged sword. Paper promises are not the same as physical possession. You were the weak hand at the poker table and the house just took your stack. Contrast that with the insider mindset. They know mines didn't suddenly discover 10 new years of supply overnight. They know solar panels, EVs, missiles, and data centers still need silver tomorrow morning. They know the only thing that changed this weekend was the sentiment of a few lines of code in New York, so the insider either buys into the blood if they have dry powder, or, if already fully allocated, simply turns off the screen, goes for a walk, waits for the dust to settle. Price is what you pay. Value is what you get. Right now, price is wrong. Value hasn't changed. Segment 8. This is the shakeout before the real move. David Morgan calls this phase the shakeout. A real bull market cannot run to completion on hype, debt, meme trades. It needs to throw off the riders who are just there for the thrill, crush the tourists who borrowed money to gamble, cleanse the system of weak hands and fragile leverage. That's what this 30% smash into a holiday vacuum is. A deliberate or emergent flush of leverage, a transfer of paper wealth from the impatient to the patient. Western vaults where silver is a financial product to Eastern vaults where silver is a strategic asset. When Shanghai reopens and sees this price, they won't mourn. They'll thank Western algorithms for the discount and start buying again. The physical squeeze will resume, and sooner or later, the paper price, kicking and screaming, will be forced to catch up with reality. Segment 9, your Monday strategy, ghost or machine. So what do you actually do with this on Monday? If you hold paper contracts only, futures, heavy leverage, no physical, understand you're playing musical chairs and the music just stopped. Survival means cutting leverage, Reducing position size, accepting that you are gambling in a casino built for algorithms, not humans. If you hold physical metal, pick up a coin or bar. Feel the 31.1 grams in your hand. That weight didn't change. It's still the most conductive, most reflective metal we've discovered. The question is simple. Do you want to own the ghost, a line on a chart? Or do you want to own the machine, the metal that actually makes modern life function? Crashes like this are a gift to anyone who missed the boat at higher prices, a second chance to accumulate a real asset at a fake, temporarily suppressed number. It won't last forever. The physical shortage is real. Premiums are real. Mines take a decade to build. It takes 10 seconds to smash a future's price. When the paper market finally breaks, the contract you're staring at will be just that, a promise in a bankruptcy process. The metal will belong to whoever refused to be shaken out in weeks like this. You've been watching John A.G. here, and I'm OG John A.G. If this helped you see today's 30% silver crash as leverage dying and wealth transferring, not silver losing value, hit like so this kind of forensic breakdown doesn't get buried, and subscribe with all notifications on. So the next time the algorithms raid an empty house, you're the one buying the furniture instead of being sold along with it.